How correlated is Europe with the United States when it comes to stock markets? And then how does Brexit and British stocks factor into all of that?
I think directionally they're very correlated. So you would expect, it's pretty unusual to see a world where US stocks are rising and European stocks are falling and vice versa. So directionally we would expect European and US stocks to be going up together. You've got still pretty healthy growth in the US. We just saw last week the Conference Board leading economic indicator tells us that the outlook for the US economy remains quite healthy. In Europe, yes, you're seeing some rollover in the PMI data, but it's still consistent with growth of nearly 3% year on year in real terms. So I think European and US stocks will continue to move higher from here. The UK, on the other hand, is the one sort of major equity market where we just want to be neutral at the moment and not taking big positions either way. I wouldn't be shorting UK equities because there's a good chance that what we see is that real wages start to improve as wage growth picks up and inflation comes down. But on the other hand, you've got all this political uncertainty in the UK, and as a result of that, we think it makes sense just to be neutral on UK stocks.
And so, Mike, talk to us then about earnings seasons in both jurisdictions. Have we seen peak PE ratios? Have we seen, peak upgrades to analyst forecasts?
Well, I mean, if you look at earnings season, they're coming through really very strong. So obviously, I mean, what's fascinating is how long it's taken for the upgrades in the US to come through. You would have think, given that the passage of the tax bill took place before the start of the year, that you would have had those numbers come through into analyst earnings expectations. Instead, you've only really started to see that come through in the last month or so. And in the US, you've had pretty significant earnings upgrade, which has actually compressed the PE because the E's been going up. Now, in the Eurozone, again, you're getting double-digit year-on-year earnings growth coming through. I think as we head into this year, particularly with the appreciation in the euro, probably we're looking at earnings growth for 2018 in the Eurozone of somewhere around the 8 to 10% level, but still pretty healthy.
I showed a chart earlier, Mike, of the UK dividend yield sort of losing some appeal over the 10-year gilt yield. We talk a lot about where the 10-year Treasury yield has to hit for it to actually hurt equities. Is there a specific yield that you're targeting either in the US, Europe or UK where those equities then start to become less attractive?
Well, I mean, historically, you've needed 10-year yields somewhere near 4% for it to cause the correlation between equities and bonds to turn in a way that you would worry about rising bond yields starting to impact the equity market in a bad way. Now, I don't think you're going to get to 4% yields on the 10-year yield at this cycle, probably. So I'd be less focused on what happens on the 10-year part of the curve and more focused on base rates. And I think that we're probably healthy for the US economy until we've got interest rates at the sort of upper bound of Fed funds. Once that's above 3, then we start to think a little bit more carefully about what that means for the US economy. But even if we get 4 rate rises this year, that only takes us to 2.5. So I think we're safe for this year. But then if we're starting the year at 2.5, we have to look forward to next year and question, is that going to start to become a problem in the second half of 2019 or early 2020?